With stocks crashing and the economy weakening, everyone is wondering, what's the next domino to fall? Believe it or not, but it could be the housing market. And that's because the Trump administration is reportedly planning to privatize 2 government companies involved in the mortgage market. And this could cause housing prices to fall and mortgage rates to rise. And that's why today we're going to bring you up to speed on what's been going on, when these changes could come, and how they could affect the housing market. This is a video you do not want to miss. Let's start with a bit of history. In the 1930s, it was extremely difficult to buy a house, and that's because the down payment was massive and it was hard to get a loan. In the United States, the down payment was 50%, and the Great Depression made it next to impossible to get a loan due to the high risks of default. And that's why, in 1938, the US government created the Federal National Mortgage Association, or FNMA, also known as Fannie Mae. Fannie Mae basically made it easier for Americans to get mortgages, and in 1968 it became a private company, essentially because it was no longer needed as a government program. Of course, there were still some Americans who needed help with mortgages, namely those with lower incomes. And that's why, in 1970, the US government created the Federal Home Loan Mortgage Corporation, or FHLMC, also known as Freddie Mac. Interestingly, Freddie Mac also ended up going private in 1989. In any case, contrary to popular belief, Fannie Mae and Freddie Mac do not issue mortgages. What they do is buy the mortgages from issuers such as banks, bundle them together into financial instruments called mortgage-backed securities, and then sell these securities to investors. At first glance, you might think, well, this sounds like a Ponzi scheme of some kind. But upon closer inspection, however, you realize that this function is critical to making mortgages affordable, especially longer-term ones like the 30-year mortgages that's become the standard in America. I'll use an example to explain why. Imagine you take out a 30-year mortgage for $1 million with a 5% interest rate, and suppose this mortgage is issued by a bank. Logically, this bank is going to be waiting for 30 years until they can get their money back, which is not ideal from an operations standpoint. Ideally, the bank would be able to sell your mortgage to an investor at a moment's notice, or even just use it as collateral to get additional cash for money to use in its operations. Well, the bank would have a hard time finding an investor, much less a lender, who could accept your mortgage as collateral. And that's simply because there would be a significant amount of risk. If you failed to repay the mortgage for whatever reason, whoever owns that loan could lose the money. But what if someone like Fannie Mae took your $1 million mortgage and combined it with 100 other similar mortgages? Suddenly, there is significantly less risk for the holders of these mortgages, because even if you fail to pay the mortgage, there are 99 other people who probably will continue paying theirs. And this is good for investors, especially large investors who are looking for a place where they can earn a high passive income, and they can get it effectively by buying your mortgage and getting your monthly payments. It's also good for the bank because it doesn't have to hold your mortgage on its balance sheet, worrying about whether it will need that money. It can just sell your mortgage to Fannie Mae, who will then combine it with other similar mortgages and then sell that mortgage-backed security to big investors. More importantly, this arrangement is good for home buyers because it makes it possible to have a 30-year mortgage with just a 5% interest rate. You see, under normal circumstances, giving someone a 30-year loan would come with a high risk, would therefore result in a much higher interest rate than 5%. But when you combine multiple mortgages together and make it possible for other people to invest in these mortgages, it has the practical effect of lowering the interest rate on these mortgages. Obviously, 2 of the biggest entities that make it possible for investors to do this are Fannie Mae and Freddie Mac. To put things into perspective, Fannie and Freddie have a combined 70% market share of the US mortgage market, providing nearly $1 trillion of liquidity to this market. And FYI, Fannie Mae's focus is larger mortgages, while Freddie Mac's is smaller mortgages, hence the reason why Fannie makes more money than Freddie. Speaking of statistics, we've noticed that 36% of the people who watch these videos are not subscribed to the channel yet. So if that's you, you can change that right now by hitting that subscribe button, and you may as well hit the bell as well to make absolutely sure you don't miss our next video. So now that you understand a bit about Fannie Mae, Freddie Mac, and the US mortgage market, we can fast forward to 2008, when said mortgage market almost brought down the entire financial system. In short, Fannie and Freddie started buying much riskier mortgages from these lenders and then selling them to the investors as per usual. These so-called subprime mortgages were not like our hypothetical combination of $1 million mortgage from earlier. Subprime mortgages were a combination of low-quality mortgage loans that probably should have never been issued in the first place, but were nevertheless bundled together and sold to investors. When the mortgages within these securities started going bad, key players in the financial system stopped investing and lending, causing a collapse. Fannie and Freddie were among the hardest hit because many of the subprime mortgages that they had purchased and bundled had lost substantial value. The result was that the US government had to step in and bail out multiple financial institutions, including Fannie and Freddie. The difference in Fannie and Freddie's case was that the US government actually took control of both companies as part of the receivership process and forced them to repay the money. For context, Fannie and Freddie lost over $300 billion between 2008 and 2011 as housing prices continued to collapse. In 2012, the US government announced that both companies would repay this money using their profits. By 2019, this money was indeed repaid, and Fannie and Freddie have since started keeping the profits they've earned as capital reserves in preparation for a potential return to the private markets. That same year, the Trump administration actually planned to make Fannie and Freddie private again, but these plans never went into effect. Subsequent interviews with key players involved revealed that it was because they realized how long it would take to do this process through Congress. And this begs the question of why the Trump administration wants Fannie and Freddie to be private again. And the answer really depends on who you ask. Many critics believe that Trump wants this because it would cause the stocks of both of these entities to pump and supposedly enrich insiders. However, many proponents argue that the de facto takeover of Fannie and Freddie by the US government has made mortgages artificially cheap and has contributed to the housing bubble we've seen in recent years. You see, the example we used earlier about investors buying mortgage-backed securities to drive down mortgage costs assumes it's a free market where there's actually risk involved. But in reality, there are technically next to no risks for the investors buying these mortgage-backed securities issued by Fannie and Freddie because both companies are ultimately backed by the US government. And this makes the mortgage-backed securities issued by Fannie and Freddie much less risky than others in the eyes of investors, creating a kind of duopoly while simultaneously pushing mortgage rates significantly lower. The result is that housing prices have exploded higher in large part because mortgage rates have been suppressed by these dynamics, making it easier for people to borrow. And this has been good news for those who have qualified for these mortgages, but bad news for those who haven't. And this is where things get a bit complicated, because the privatization of Fannie and Freddie would fundamentally increase mortgage rates, which would cause housing prices to fall. But in the short term, this could actually make housing even more unaffordable, as mortgage rates would rise while housing prices are still elevated. In the longer term, housing prices would indeed fall and become more affordable, but this would practically come at the expense of 65% of Americans who already own homes. They would see the cost of their properties plummet while they continue to pay the mortgage on the original inflated value of their home. To add insult to injury, Fannie and Freddie would likely lose market share to other mortgage lenders if they went public, assuming their government guarantee was indeed removed. And this means that even investors in Fannie and Freddie stocks would lose money. It seems that nobody would win in this new arrangement.
The Coin Bureau Deals page. It won't make you stronger, but it will make you better at crypto.
But let's back up a little bit. You'll recall that the Trump administration was planning on making Fannie and Freddie private back in 2019, but that these plans never went into effect due to the congressional hurdles. For reference, it's believed that it would take as long as 4 years for Congress to approve their privatization. And this begs the question of how the Trump administration will actually do it. The answer is what we've seen Trump do in other contexts, and that's to use the executive branch, specifically the Federal Housing Finance Agency, or FHFA, and the Treasury Department. The former oversees Fannie and Freddie, and the latter provides the government guarantees, so to speak. As some of you may have heard, the FHFA recently got a new director named William Pulte. William is a businessman who's apparently very good at buying companies, building them up, and then selling them off. It should come as no surprise then that the first thing he did after being confirmed by the Senate in March was to fire multiple board members at Fannie and Freddie and start looking for places to cut costs. What is surprising, though, is that William supposedly did this for purely operational reasons related to the Trump administration's agenda of cutting costs in the government. William subsequently stressed that privatizing Fannie and Freddie was not a top priority, and something that would only be done once the US government had assessed how much their privatization would affect the mortgage market. And this is where the Treasury comes in. As I mentioned a few moments ago, the Treasury is another entity involved in the privatization of Fannie and Freddie, because it would be the one to decide whether it continues to provide a government guarantee for the mortgage-backed securities that they offer. Well, so far, Treasury Secretary Scott Bessent hasn't had much to say about Fannie and Freddie, just that Trump's upcoming sovereign wealth fund could invest in both companies. Naturally, the media has taken this commentary as confirmation that privatization is imminent, when it really doesn't seem to be. Even so, experts on Fannie and Freddie's privatization, such as Chris Whelan, have highlighted the fact that the Treasury would still need to provide a government guarantee for there not to be any major issues in the mortgage market. Then again, Chris believes that the government guarantees would be expected regardless. After all, they bailed them out once before, investors know they probably would do it again. Chris has also underscored the fact that the connection between Fannie, Freddie, and the US government means that the credit rating of their mortgage-backed securities would be heavily dependent on the credit rating of the US government. If rating agencies downgraded US debt because of, say, a debt ceiling debate, then this would negatively affect Fannie and Freddie if they were private. Moreover, even if Fannie and Freddie were able to go private with minimal impact on mortgage rates, it could still create a problem in the long term. And that's because their privatization would open up the mortgage market to more competition, eroding their duopoly and eventually causing mortgage rates to rise. There is a silver lining, though, and that's that Fannie and Freddie are nowhere close to going private. Besides assessing the impact on mortgage rates and coordinating with the Treasury and other key players in the industry, Fannie and Freddie need to build up their capital reserves before going private. The Congressional Budget Office estimates that Fannie and Freddie would need anywhere between $267 and $534 billion in capital reserves to go private without causing any disruption to the mortgage market. Right now, their capital reserves are believed to be somewhere around $150 billion. Given that Fannie and Freddie's combined capital reserves are growing at a rate of roughly $20 to $25 billion per year, this means that it will be at least another 5 years before either entity is ready to be privatized. And if we assume the upper capital reserve range of $534 billion, that timeline increases to 15 years. And this brings me to the big question, and that's what all of this means for the housing market. Well, in the short term, it means nothing, because it looks like it will be years before Fannie and Freddie are privatized, if ever. What it means in the longer term depends on whether it actually happens. That said, there are two related factors that could affect the housing market in the shorter term. The first one is what I mentioned earlier, and that's the credit rating of the US government. The fact of the matter is that the US stock market, bond market, and even the economy have been in flux in recent weeks. Not only that, but US politicians are currently in the process of passing a spending bill to raise the debt ceiling, which could come with all sorts of issues. This could result in the US debt being downgraded, which would result in slightly higher interest rates on all debts in the US, including mortgages. And this ties into the second short-term factor that could affect the housing market, and that's US interest rates, specifically the Fed's rate policy and the yield on the 10-year government bonds. Now, for those unfamiliar, the Fed affects the short-term interest rates, while the US bond markets affect the long-term interest rates. In this case, the most important bond is the 10-year because it's used to price mortgages. If the 10-year yield is, say, 5%, then chances are that the interest rate on 30-year mortgages would be slightly higher, say around 6 to 7%, like it is now. And that's because 10-year bonds are seen as a low-risk source of long-term yield for investors, so all other long-term debts are priced at the 10-year yield, plus a few percentage points to compensate for any additional risks, such as the 30-year duration of the mortgage. In turn, the 10-year yield is driven by a combination of factors, including the Fed's interest rate policy, economic growth, inflation, and bond issuance. Higher interest rates from the Fed, strong economic growth, high inflation, and more bond issuance all contribute to a higher 10-year bond yield, which means higher interest rates on US mortgages. Well, let's just say it's not looking too good there. The Fed seems determined to keep interest rates higher for longer. The US economy has been weakening, but not enough that it's recessionary yet. Inflation is expected to rise because of things like tariffs, and the 10-year bond issuance will increase after the debt ceiling is raised. Notably, the 10-year bond issuance will increase even more when the US government stops borrowing much more money using the short-term bonds. Taken together, this all suggests that long-term interest rates will continue rising in the coming years, along with mortgage rates. If they do, then the effects on the housing market will be almost identical to the privatization of Fannie and Freddie. Lower housing prices, but also more expensive mortgages. Again, in the short term, this could mean housing prices staying high while mortgage rates rise, which is almost exactly what we've been seeing in recent months. It's only in the longer term that housing prices would start to come down, which will be good for the 35% of Americans who don't own homes already. The remaining 65% will see the values of their properties fall while also continuing to pay a big loan. The silver lining is that by the time Fannie Mae and Freddie Mac are privatized, the worst effects of the housing market would have already happened because of other unrelated factors. As such, the primary impact of privatization would be that it prevents a new housing bubble from forming, at least until new government programs are introduced that start blowing the bubble back up again. It's easy to forget that both Fannie and Freddie were originally government programs intended to help the average person afford a home. Over time, these institutions went private and helped create a housing bubble that resulted in the 2008 financial crisis. Rather than accept the outcome, the US government stepped in, kicking the can down the road, and that's literally what's been happening since 2008. Everyone knew that someday we would have to face the reality that the current financial system is unsustainable, particularly the housing market. And it looks like we will face this reality regardless of whether Fannie and Freddie are privatized or not. But who knows? Maybe there's room for another few kicks of that battered old can before it disintegrates entirely. And if you want to learn more about whether the world could enter a recession, check out our latest video on that right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you very much for watching, and I'll see you again soon.